So I had an old buddy of mine come to me and tell me that he kept blowing his account. So I took a look at his trades and come to find out that he wasn't using a stop loss. I'm like, bro, what in the IML, multi-level marketing, iMarkets Live, use no stop loss, blow my account is going on here? And by the way, he's not the only one guilty of this. A lot of traders, especially brand new traders who haven't been taught the right way, trade just like this. They trade without a stop loss, and that's a sure way to eventually blow your account. It's inevitable. One bad trade can completely wipe everything away. And in today's video, I'm going to talk about exactly that. Today, we're talking about stop losses. So if you're one of those people who doesn't use a stop loss and continues to blow your account, you need to
stop it. Get some help.
I don't care if you're a beginner, intermediate, or advanced trader, you're going to want to watch this one. Because in today's video, I'm going to teach you how to place a stop loss in order to give you an edge in the Forex markets. Not only that, I'm going to help you think like a professional when it comes to stop loss. And as a bonus, I'm going to teach you how to avoid getting your trades stop hunted. So if you find this video useful, I just ask you for one favor. Just hit that little like button to feed that juicy YouTube algorithm, and let's roll the intro. So when it comes to placing a stop loss, there's really only one rule that you must follow, and it is to place your stop loss at a point where your trade idea is no longer valid. Let me give you an example. Let's say we're currently in an uptrend and the market is trending upwards and you want to enter a buy. Question is, where should you put your stop loss? So let's say you enter your buy on this level right over here, and you're trying to figure out where should you put your stop loss. So you can either put, let's say you can put your stop loss here, or here, or here. So question is, out of these three options, which of these three stop loss areas makes your trade idea no longer valid? Let's think about it. So we know we're in an uptrend because we have higher highs and the lows are getting higher as well. So higher lows. So at a point, if the market pulls down up to this level and bounces off of this area, could this still be considered an uptrend? Yes. Second option, let's say the market goes down to here, and then it pulls a U-turn, and it continues to go mess around about, and it continues to go up. Could this area still be considered an uptrend? Yes, because the low still hasn't gotten lower. So option C, the third option, let's say the market pulls down here. If it does something that looks a little bit kind of funny, this kind of represents that the market might be changing directions. So this area, the third point, would be the best area to put your stop loss. Let me give you another example. Let's say the market is not trending anywhere. Let's say the market is just simply consolidating. It's just going up and down, up and down. And let's say you wanted to enter a buy. Let's say you wanted to enter a buy at like the zone. You see a support area, then you also noticed a resistance area. Let's say, you know what, you decided to just give it a shot. You say, you know what, let me just try to buy it on this, and I want to close my trade up here if it hits take profit. Question is, if you entered right here, there are some possible stop losses you would be able to choose. You could put your stop loss, let's say here, you could put your stop loss here, or you could put your stop loss here. Question is, which one of these will make your trade no longer valid? So you have to ask yourself, let's say if the market pulls something like this and it continues going up, is this zone still valid? Yes. What happens in the scenario where the market goes down here and then it continues going up? This trade is still valid. Therefore, if you put your stop loss here, you would have got stopped out essentially for no reason, meaning you shouldn't put your stop loss there either. However, if you put your stop loss below the zone, let's say down here, this could mean that this consolidation, that this support zone has now broken, and that this trade idea is no longer valid. So out of these three options, this would be the best fit in order for you to have the highest chance of not getting stopped out prematurely. And the reality is, I've seen way too many traders put their stop loss literally at this zone, saying that if it touches this area, they're going to accept their loss. This is the worst place to put your stop loss. So I would not recommend that. Now, I'm going to hop on the charts to give you an example, but before I do, I want to talk about stop hunts. Let's say you're in a consolidating market, and let's say you wanted to enter a buy at this support zone that you noticed, and you just wanted to enter a buy here. And let's say you put your buy limit, and you're looking for a buy, and let's say the market does something like this. it dipped below the zone before continuing in the up direction. This is what we call a stop hunt. Let's say you were managing an institutional fund and your fund wanted to enter a massive whale position of a buy of going long on USD CAD. Let's say you wanted to enter here. And because your trade size is so huge, there wasn't enough liquidity in order for you to enter your position without the market moving upwards as you're continuing to accumulate your buys. Let's say you're putting in millions upon millions or even billions of dollars for a buy, that would make the market go in the up direction. So you wouldn't want to put your buy here because that would drive the market up and you would be getting not an ideal price compared to what you could have. However, you come to the conclusion that there are many people putting stop losses in this exact little zone right here. So you would rather put your buys here because every time a stop loss is hit from someone, that is a sell that they are actually doing. So when you are buying up, as their stop losses are being hit here, it's providing enough liquidity to avoid the price from spiking up because there's a lot of liquidity in this area. And as their stop losses are hitting, you're buying up their stop losses, and that allows you to get a lower position as an institution before the price starts going in the up direction. So as you can accumulate your position, triggering all the people stop losses who has a stop loss at this zone or even right below the zone, is triggering all their stop losses, which is allowing you to get your position in without making a crazy massive spike in the market. So how do we as retail traders avoid getting caught in this stop hunt? We need to place our stop losses wide enough to not get caught in this fire. Because sometimes traders just eyeball it, and sometimes you might have a stop loss that's way too large. Sometimes you might have a stop loss that's way too small. It's more just based on perception. Sometimes you might get caught in that line of fire when it comes to getting your trade caught in the stop hunt. So in this video, I'm going to give you one approach that you can use in your trading strategy to avoid getting caught in these little stop hunts right here. So let me go ahead and clear this out and let me show you. So we're using TradingView right now. And by the way, guys, if you guys don't have TradingView, there's a link in the description to pull it up. But what you would actually do, you would open up the indicators from up here and you would just search ATR. And you would click the one that says average true range, ATR. So we would pull up this indicator, and let me kind of show you how this actually works. So let me go ahead and go to the chart. This indicator does not tell you the direction of the trend. So don't think that this indicator trending upwards means it's an uptrend, or trending downwards it means it's a downtrend, or any of that stuff. So this indicator simply tells you how volatile the market is. It's just an indication of the volatility of a market. So you're not going to use this for any trend-based indicator, using it just to see how volatile the actual market is. So let me kind of explain how this works. So this ATR indicator, you'll notice it has these little numbers. As I move the mouse, these numbers are kind of moving along with me here. This shows you the number of pips of how volatile the market has been, in this case, over the past 14 candles. Example, on this date here, on this exact candle here, the market average volatility, the average true range of the market in the past 14 days was 83 pips. And the day after that, it was 83 pips, 84 pips, 83 pips. And then you go over here, it was 81 pips of volatility in this pair. It was 101 pips of volatility here, 98 pips of volatility, and 104 pips was the ATR, was the average true range over these last 14 candles from the point where I indicated that. Now, if you look at today's date on this candle, the volatility is around 105. The average true range, the ATR, is 105 pips. So how do we use this to our advantage? I want you guys to think, if the market is more volatile, if the ATR is higher, if the market is moving up and down much crazier, won't we agree that our stop loss should be relatively bigger? But what if we're at a time in the market where the volatility isn't too big? The market really isn't moving up and down with wild swings too much, and the ATR is low. Do we need a big stop loss for a time, a period where the volatility isn't too crazy. No. So this gives you a rules-based approach that allows you to have a variable stop loss based on the market conditions at that time and based on the current currency pair that you're actually trading. So let's go ahead and use this indicator, and let me just give you like a quick little example. Let's say you saw this market was going in like a little uptrend. You noticed the lows were getting higher. Then you also noticed that the market itself was like, I guess, like consolidating. And let's say you just want to enter like a buy, right? You want to enter a buy. You just want to give it a shot. You want to enter in the up direction at the bottom of the consolidation. Basically, just like the examples that I gave you. So let's say you see this little support area here. Let's say you kind of want to enter a buy at this support. So let's just say you put a buy limit somewhere here. You just want to enter a buy just whenever the price reaches this this support. Let's say let's say where the wick is at the support, and you want to enter your stop loss. So you know where you want to enter your buy, and let's say you want to take profit at the top of the range. So let me go ahead and draw this zone here as well. You want to enter your TP somewhere in this range here. And now we got to figure out what we want to put as our stop loss. So what would we do? We would go to the ATR, we would go to the average true range, just kind of see like where is the ATR at. And by the way, I usually kind of mostly do this on like the daily time frame. So you just kind of see like what the ATR is saying. It's saying around 90 pips is the ATR. So what you can do, you can put your stop loss as wide as what the ATR is, or you can do your stop loss at 1.5x of what the ATR said, or you can do your stop loss at 0.5x of what the ATR said. So 0.5x would be 45 pips, and 1.5x would be around 130, 135 pips. Or you can refine this even further and do something that fits your trading style the best. So for example, you can even do 0.8x of the ATR or 0.75 of the ATR. And as the market gets closer, once you enter your trade, you will kind of look at what the ATR is pretty much when your trade gets activated. So let's go ahead and continue and kind of show you what I'm talking about. And let me go into like the 4-hour time frame just to get a closer view. This was the support area. Okay, so the trade got triggered here. So we are now in the trade. So let's go back to the daily time frame and kind of see what the ATR is saying. And let's go ahead and make sure our stop loss is adjusted accordingly. So this says 87 pips. So in this example, I'm just going to do 1x of the ATR. So I'm going to make my stop loss just 87 pips. So one way you can do it is just like double click this little thing here and it'll open the long position up for you. And then you can just change this to 87 pips. So I'm just going to do 870, hit OK. And now our stop loss is set at 87 pips. Notice this is roughly wide enough to try to attempt to avoid any potential stop hunts. And this gives us a risk to reward ratio of 5. We have a stop loss of 87 pips. We have a take profit of 443 pips in this case. And we'll just continue, go back to the 4-hour and just kind of see how this plays out. Okay, so the market breached below that, and then it continued to go back up. So let me go back to the daily time frame. Okay, so notice this wicked down below the zone, but it closed within the consolidating area, which makes our trade idea still valid, and our stop loss was wide enough to give us a buffer for now, to give us a buffer to avoid any potential stop hunts, for example. Now, some of you might be thinking, hold on, so if I just don't even use a stop loss at all though, then I don't have to worry about stop hunts because I'm not gonna have a stop loss. And if the market does wick anywhere, I'm not gonna get stopped out. Let me explain why that's a terrible, terrible idea. Let me go ahead and clear everything on this page here. And let's say you were trading without a stop loss, and let's say you were doing it in a downtrend, and You were just trading and you were just putting in sells. You were trading with the market, with the trend. You were putting in sells wherever you wanted to put in, meaning it doesn't even matter where you entered the trade. You were just putting in your sells and riding the wave down. You were entering sells. It doesn't matter where you were entering your trade, even if the trade went against you a little bit. It doesn't matter because the market kept going down. No matter how far the price went into your stop loss, you didn't care because the market was trending down. And you kept trading all these sells without a stop loss, and you were making a stupid amount of money in it. You're making so much money in like this whole year because the market was trending down and down and down. And let's say you were just marking up your chart and you were putting in all these sells and any single point that you saw fit. And let's say you did the same thing here. You're looking at this resistance area here and you wanted to enter another sell. So you enter, copy and paste, you enter another pending sell order to enter a sell on the downtrend because the market is trending down and you have all these winning trades that you've done in the past and you just want to continue to ride that wave. And remember, in this scenario, you're not using any stop losses and it's been doing wonders for you. You've been making a stupid amount of money and you haven't lost any trades. Let's say you've won 50, 60, 100 trades in a row, which is insane, and you just let them all ride and you were making a lot of money in it. So let's see what happens. Your trade gets triggered and no worries. This is just a normal market reaction, just like the price went up here for your sell and the market continued to go down and you were making a stupid amount of money in it. So that's no big deal. Hold on. What's happening here though? Okay, good. It's going to come back into profit. So we're okay. And now it's been 2 weeks. You're still in a loss. You haven't used a stop loss. You're still in a loss. How deep of a loss are you in right now because you still haven't used a stop loss? 380 pips. So we can fast forward this all the way. This has been 2 months, 3 months. It's now 2022. It's been half a year. It's been a whole year. You're still in that negative losing trade and it still hasn't reached back to break even to where you can at least take your money out without losing in a bigger loss. And at this point in today's market, had you done this strategy, you entered your sell here and the market still has not reached even the break even point. So the question is, how big of a loss are you in right now? 830 pips with no end in sight and you were in the trade for over 399 days. So 400 days in a losing trade. This right here, one mess up, this one trade, depending on what your lot size was, one trade can completely wipe away your account. I don't care if you had a $5,000 account, $10,000 account. If you had a 10 lot trade, if you were doing 10 lot trades on the way down and you had a 10 lot trade or a 15 lot trade looking for another sell, one trade can completely wipe everything away. And you were in this losing trade for over a year with no end in sight. So out of 50, 60, 100 perfect trades, all it takes, and this is very important for you guys to understand, all it takes is just one trade messing up to completely wipe away your account. It takes one trade and your whole account is gone. And I've seen far too many traders get stuck in this trap that completely lose their account. Matter of fact, this is the exact reason why so many traders blow their accounts. I talk to hundreds and hundreds of traders, and this is the reason why traders blow their account. Either their lot sizes are too big or they're not using a stop loss and the trade continues to go against them until they've blown their account. Guys, trading without using a stop loss is a very dangerous game to play. I've seen traders lose over $250,000 trading gold in a matter of 3 days just because they didn't use a stop loss. I've seen traders lose over $1 million, completely blow their account trading gold just because they didn't use a stop loss. That being said, don't be a statistic. So I hope this lesson was valuable for you. If it was, I encourage you to hit the like button on the video and share this with someone. Share this with someone who's blown their accounts many times. Share this with other traders that you know that are struggling who need some help. Let's work together to educate people on how to trade like a professional so you can grow your account using a rules-based approach. That being said, take care guys, and I'll catch you guys in the next video.